Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. So that's kind of a snapshot of the market. So unless there's questions about any of that, I'd like to move right into planning. So let me just check my screen, see if there's any questions. No. Okay, so I'm going to share my whiteboard with you. All right. All right, so we're going to talk about the 3 pillars of investing. This is really for, and just do me a favor, raise your hand if you can see my whiteboard. I should say 3 pillars. Thank you. So this is my phrase, 3 pillars of investing. It doesn't, I don't think I've read it anywhere, but you read so many books and articles. If I'm not attributing it to someone, I apologize. But none of my strategies are new. I haven't personally developed anything. I've just brought things that I thought would be helpful to our practice and our clients. And the 3 things that I found very helpful are asset allocation, of course. We're going to talk about what that means. Principal protection, that is having something in your portfolio that gives you preferably a floor of 0. So in any given year, your investment can't drop below 0. And then the third being what I call account segmentation. David McKnight in his book calls it time segmented investing. And it's funny, I told this story, but David and I were chatting on the phone one time, and we both started implementing this at the same time, because I said to him, you know what I've started to do that really makes a difference? And he said, that's in my new book. And shortly after that, he sent me the manuscript. So I felt like I was in good company there. So so the idea behind those 3 pillars is to allow an individual, a couple in their financial plan, to have the growth that they may need, while having the funding that they need early in life and the protections against market volatility. I should say hardly anyone ever comes to us and says, I want to make as much as possible in my investments. If someone comes to us and says that, they're not a good fit, because they could do really, really exceedingly well, or they could be on the streets in a short period of time. And I know that might be excessive, but they could run out of money, and they could be taking risks that they aren't aware of. We've been very, very lucky over the past decade plus with our market returns, and it's easy to forget how fast things can turn. Even now, a year away from the V-shaped return that we saw last year with the COVID drop, I'm reminding people that the markets can be volatile. A year and 6 months ago, I was standing in front of classes reminding people of the Great Recession. And most people had remembered that, but forgot the feeling of losing those funds. And that's the tough part. And you're 10 years older than you were, 10 years plus, than the Great Recession. So do you really have time to recover? Well, we may be able to structure something that will allow you to recover, but you've got to be careful about your investments. On the other side of that, you can't put it all in cash, because, well, I guess few people can. If you're a billionaire, if you have, hundreds of millions of dollars, you could probably live off of very low interest rates, but no, most people can't. You've got to keep pace with inflation. We're seeing tremendous inflation right now. That's a big concern people have. So you've got to have a balance of some money that's protected and safe and available, and some money that's set aside for growth. And there really becomes the science, the art, whatever it is. So we develop strategies to help with that. And this is what I want to try to explain to you, because as I talked to you last week, the review is so important. You may have heard me say this hundreds of times. You may have read these strategies somewhere before, but the repetition is really important, because you have 30 plus years potentially in retirement, and it's important to understand. You don't have to know the nitty gritty of it, but it's important to understand why we're doing the things that we're doing. And that repetition is important. That's why that's another reason annual reviews are important and annual financial planning meetings are important. It's not always just about the numbers and the plans, but the remind and review, make adjustments, change implementations. That's really what these strategies are for, because you've got to have a comfort level of what you're doing in your plan, because otherwise you can get pulled off course. You can get pulled off course by words from a relative, a trusted professional. I had a client who was a little upset at some comments her CPA had made about Roth conversions. And after we had a joint conversation, everything was fine. But it can happen to anybody, because you hear things from different people, and you've got to make a decision based on what I'm hoping is sound advice from everybody involved. And again, it's good to review these things. So let me stop talking about that and let's review. So what are the 3 pillars? So I'm going to be looking down. Now I'm hoping, I discovered in our annuities talk that the sound was a little off. That's the trouble with these videos, right, being recorded, because I hate it when I look at them and I see things that I don't like. But so if I sound a little muffled when I'm looking down, just raise your hand for me so I can pay attention to that. So we have these 3 pillars here, and the 3 pillars are: 1, asset allocation; 2, principal protection; and then 3, we're going to talk about account segmentation. And I'll pride myself on something here. Almost everybody does this first one. Everybody in my industry does this. The Morgan Stanleys, Merrill Lynch's, everybody does asset allocation. And everyone talks about asset allocation. So everybody does this. Many people also couple in the principal protection, especially when you get to the independent, folks like me, the registered investment advisors, the independent type of financial planners and financial advisors out there. We're big fans of principal protection, using things like structured CDs and annuities to help offer some protection. So that's you get a lot of that. I'm going to just give this a dot, because very, very few people are using this account segmentation. I had a discussion. I think I told you I was down in Texas a few weeks ago, meeting with our partners, Kestra Financial, and they're putting together a new investment management team, and that has to do with just helping us being able to screen portfolios and making sound investment choices for you folks. So I had a question, or I was given the question of what would be the best structure for this kind of team, and what are we looking for from folks like us. And I talked about the account segmentation, and as we discussed it, I said, how many advisors are doing something like this? So out of the 1,500 to 2,000 advisors that are partnered with Kestra, there are only about 4 who take this approach. And this approach is so valuable, but it's extremely time-consuming and difficult. So I understand why people don't do it, but this is the benefit of having a smaller boutique firm with fewer clients, so we can really spend the time needed. So let me go and talk about the first thing. And the first thing is asset allocation. So asset allocation is a relatively simple format. You spread your funds among different categories so that you're not overweighted in one area, right? So let me just make this a little more. So if you had all your money in US stocks, and suddenly the S&P 500, or the Dow Jones Industrial Average, drops significantly, then you're overexposed in that area. And if that area is down 35%, well, if you're 100% in this component, well, you're down 35%. 35% is a big number in anybody's book. And the same with non-US stocks or bonds. But the idea is if you blend it over, then certain things offset others. And as the US stocks, let's use US stocks for green, as they go like this, perhaps, and this is the idea, let's say that bonds are red, I'll make that smaller too. Perhaps the bonds, in a perfect world, the bonds, right, are acting like this, an inverse effect. That's not really how it works, but that's the idea, because then you have a line of growth that balances both of those. And that's the general theory behind asset allocation. Many times that doesn't work because of correlation. We call it correlation. So things move the same way. And then you have areas where you have bonds in here, and bonds are in this section here. I'm sorry, no, they're not. What are they? They're orange. So forget about that. Bonds are in this section here. Sometimes, as I said, as interest rates go up, bonds values, depending on what they are, can go down. So when someone goes into retirement and they have the typical 60-40 split, right? So 60% stock, 40% bonds, and they do that thinking that and allocate it in a different way. You have U.S. stocks, non-U.S. stocks, bonds. Other might be real estate, maybe some gold or precious metals, and then cash. You typically want to hold a portion of cash. A minimum amount of cash is usually 2%, but this here shows 18.86, and that's fine too. So when you have 60-40 bonds here, many people are thinking, well, this is my safe money here, but bonds can drop quickly and dramatically depending on how they're invested. And the problem is most people have them in bond index funds, which we'll talk about in a couple weeks, or ETFs, exchange traded funds, or mutual funds. Most people don't own individual bonds. So when those bond values drop within those funds or ETFs, you have really no control over it other than selling the position you have. They're going to go down, and we've had a significant run over the past couple decades with bonds, and the concern is they're either going to be very stagnant or down. So, but the whole idea behind asset allocation, absent my commentary there, is that blending these things is supposed to give you this balance here, right? That's the idea behind asset allocation. Now, again, everybody does this. Everybody who invests says, we're going to develop an asset allocation strategy for you, and then we're going to rebalance that. We're going to find the best components, right? We're going to find, these are not, I'm not talking about real companies, the ABC fund, who's the best of the best. We're going to make sure we monitor that. And if there's any changes we need to make, we'll do that for every category, and we'll rebalance this so that we manage your risk, so that we make sure the funds are there. Everybody does that. The second part is principal protection. So I have to go to a different screen for that. So this is one. So this is asset allocation. And I'm going to pause there just to see if there's any questions, and there are. So just stand by. If you see me looking over here, I'm looking at the screen. All right, Gerard asked, do you utilize the income for life bucket strategies? That's, Gerard, I think what you're talking about is what I call account segmentation. So I think we're on the same page, and you're going to see that. I use buckets for something else. I use buckets for taxable, tax deferred, tax free. I like the idea of the bucket verbiage, but I think it could be confusing in my practice. So I call it account segmentation. Again, David McKnight calls it time segment investing. It's all the same, and we'll see that in a moment. So let me shift gears a little bit here. So I'm going to, so let me answer that. Okay. And I am aware I'm still sharing the screen. Okay, so what I'm going to share with you here is a risk tool that we use. And this is coming out in the form of an investment policy statement. And this is for Frank and Joanna Miller. I don't know why I can't draw on that. But I'm not going to like that now. Why can't I annotate on that? Anyway, this is for Frank and Joanna Miller. You've met Frank and Joanna Miller before. You'll see I just updated this and ran this morning for you folks. With Frank and Joanna Miller are sample clients that we have that we developed together a financial plan. We went through it, you and I, all of us, and we took Frank and Joanna Miller from running out of money at age 70 something to being fully funded for the projected remainder of their retirement using these strategies and converting to Roth IRA specifically. So this is an investment policy statement that's put out from this program we have, but you'll see here that I did a questionnaire for Frank and Joanna Miller, and I based it on it's a psychology based questionnaire with math. So it basically asks what your comfort level is with risking funds to achieve returns over a 6-month period of time. I really like that 6-month period of time because while the normal market cycle is, somewhere between 3 to 5 years, closer to 3, 6 months, we can see a lot of volatility in 6 months. And you're opening up their statements as you should, or you're checking things online and suddenly you see that your portfolio has dropped. So in the questionnaire that I, posing as Frank and Joanna Miller, did, they have $1.3 million. And what we came up with is they have a risk score of 40. So if you think of a line of, and I like it that it's kind of like a speed limit sign. Been using Riskalyze for years when it was, it might have been 1 or 2 people who developed it. And now this is one of the biggest risk management tools in financial planning and investment management. So what does 40 mean? So from a scale of 1 being the most conservative and 99 being the most aggressive, Frank and Joanna Miller said they're at about a 40. Now let's talk about that in dollars and cents. They're saying that over the next 6 months, they're comfortable achieving 11% and risking 7%. Now pay attention. Of course, anybody's going to be comfortable with the up number. Everybody. Give me as much as we can possibly get. The balance is down here in the red, the -7. I hate it that I can't annotate this, but this one here. See this -7. And what I like about this program, let me clear, now I'm stuck. I am totally stuck. That's upsetting. All right, let me refresh. I may have to go back to the beginning. Hopefully my son will edit this out of the recording. Okay. So here's where we were. So this -7%, that's what we want to focus on. But look at the number, $90,000. So they have $1.3 million, $90,000. So how comfortable would you be opening up your statement 6 months from now, or 2 months from now, or 3 months from now, somewhere in a 6-month period of time, and your investments are down $90,000? That's the gut check, right? 90 grand. Well, that's the conversation that needs to be had. Now, you'll see that, we set some objectives for them. They want to fund their retirement, wealth accumulation. That's growing their assets for retirement. And also maybe they want to pass some funds to the kids, and of course, income. It's time to start taking money out of those investments. This gives a target asset allocation. This shows their current asset allocation. So you can see we're really close, 60% stocks, 36% bonds, and there's some other here. So 62% stocks, 36% bonds. So we're in that normal 60-40 split. This is what we see all the time because it's what you're taught. It's what people read. What people read. This is what the 401k guy said to you when he came out to your work. The target would be just to reduce that risk down to 40. So this is a risk-adjusted asset allocation strategy. 40% stocks, 25% bonds, and then this other might be some real estate exposure. But in our case, this is going to be principal protection. So we're going to see the effect on this of this risk-adjusted. So this is where they currently are. Remember this 40. They said this is what they're comfortable with. Now, again, this demands a conversation. I had a client who is newly coming on board. We're just starting the financial planning process, and I think he came in at a risk score at about 75, 76, and that's just about the risk score of the S&P 500, by the way, is 75, 76. And when I showed him these numbers, I think it was $160,000 that he was risking over 6 months, or maybe even more. He said, no, that's not where I feel comfortable. So that's a really good conversation to have. And again, you should be having these once a year. So let's go back to that's their comfort level. Now let's look at their portfolio. Well, they're currently at a 56, so they're well above what their comfort level is. Look here, they're risking $144,000 over 6 months instead of that 90,000. I would say that's significantly more. Sometimes it's way different. Sometimes it's way off the charts. Many people come to us and they're at a 20 and they're in a 56 portfolio. But this is a moderate to moderate growth portfolio. This is still a 60-40 portfolio. Again, this is what clients like Frank and Joanna Miller would have coming to us before we make any changes. And these are really simple things. We've got the Dow Jones Industrial Average. We've got some Vanguard exchange traded funds and Invesco exchange traded fund. This is very, very common. So that gives us a 56. So the first adjustment is or way over their comfort level. Now, how do we handle that? Well, this is what I did to make the difference. And this shows, this is great too. This is a risk reward heat map. So it shows the individual funds and what the upside is and what the potential downside is. So this says, you know, if bad things happen, what's going to be drawn down historically. And again, this is just about, I don't know of any other better tools than this available. So now here's our target asset allocation. And what I did is I took a third, really, well, that's 32.98 is basically a third, in a principal protected investment. Now, I don't care if it's a fixed indexed annuity. I don't care if it's a structured CD, if it's a note. I don't care what it is, as long as it's given us principal protection and has some opportunity for growth. Because principal protection without any growth is not worth it. You want something that is going to protect that that negative, make sure that the floor is zero, but offer some level of growth. 3, 4, 5% annually is great. We're looking for bond-like returns with really zero risk. So you'll see here that if I can click into these, well, no, I'm probably signed out. But if I was able to click into this principal protected invested, the risk score on that would be 1. So that really helps the portfolio. So all I did in this example, was take a third of the money. I peeled it out of here very simply, out of the rest of the funds here. And they still have the same amount invested, the $1.3 million. I put $430,000 of it into a principal protected strategy. And you'll see that it drops them down actually below their risk score. So and it really doesn't change the potential return much at all, frankly. And I don't see that actually potential return, but I think it was, in my analysis, it was just about the same, if not, it could have been a little bit more. So you'll see here that this principal protection has no downside when I look at the heat map, and all the rest stay right where they are. So that's kind of step 1. You can see how principal protection really protects so this is really the scientific approach of quantify how just laying in principal protection affects my portfolio as a whole. Now, again, everybody does asset allocation. Many people who are in my field, my area of individual, independent, specialized advice also use principal protection. But is that enough? It may be, but I like to take it a step further because we still have this risk. So how do we manage this risk? So let me go back to that whiteboard. I'm not suggesting that we can alleviate all risk, but we can certainly manage your funding risk. So now let's go back and take this 30, I can write on this, 35. We got to 36, but let's go to the 35. We've decided that a third, and in this case it says bonds, but let's just say it's principal protected. We've decided that a third of this, that's a little bit more than a third, but goes into principal protection. So maybe it's going to be, carved out like that. And you saw that that greatly reduced our risk. So Frank and Joanna can sleep a little bit better at night. And most people, again, stop there and they say, asset allocation, we hope that doing all those things that we talked about, we're going to rebalance the portfolio. We're going to make sure that these components are strong, and we're going to change them as we need to. And we use very sophisticated tools called Monte Carlo simulations, which looks at 1,000 plus potential outcomes depending on the program you use, and that gives us a probability of success, and gives us a comfort level whether you're going to achieve your goals. And we know that whether you're up 10% or down, so let's use the parameters we have. Where's that? So down 6, up 12. Whether you're up 12% or down 6%, you should, right, be able to achieve your goals over this 30 years. You've got to live over the next 30 years. And this $1.3 million has to last over that period of time. And we've got scientific, programs that help you do it. And trust us, what we're told, right? It'll be fine. Well, I don't have a comfort in that. I think that's great, but most people want to see exactly where your funds are coming from and how they're going to fund it. So that's why several years ago, I started something a little bit different. And I said, what if we did it differently? What if instead of that one portfolio, although managed and adjusted, and we continue to do that, but what if we instead created several portfolios for each time in your life? Now, this is very simplified, what I'm showing you here, but this takes the principal protection out of it. Now, instead of $1.3 million, we have $900,000 that we're working with, and plus. And we're putting that principal protected money away. That might be available, and we take that out if the markets are down. Perhaps it's set up for a later period of time. But just using the $900,000, for example, what if instead we developed a few different accounts instead of just relying on one? And we know that for the first 1 to 3 years, this is what we can call segment one. You're going to need, and this is just an example, 180,000. I think these were Frank and Joanna Miller's real numbers from their financial plan. But so we put $180,000 into this segment, and we have very, very little risk. We don't expect much movement. We don't expect much of anything out of this, but we know that we're going to have there's always a little potential, right? So let's say -1 to -2%. But we know that when the money that we're going to need, this 180,000 in the next 3 years, 1 to 3 years, is going to be there for us to spend. Most people have this period in their retirement, and the first is worry. I call it the worry zone. So we're in the worry zone here, and that is typically a few years before retirement and a few years into retirement. And the worry is, I want to make sure, do I have enough money? Do I have enough money to do all the things that I want to do? And then you meet Mark Byelich and his team at Attleboro Wealth Management, and we say, well, not only do I want you to spend money on everything that you want to do, take the trips, see your grandkids, do all the things you want to do, but I want you to pay your taxes early. And I want you to, if it works for you, to fund life insurance so you can potentially draw out of it later on. So I'm adding additional costs as well. And you have this worry, can I fund that? How am I going to fund it? Where's the money coming from? So instead, and then this goes back to George's bucketing. Again, I call it segmentation. These can be considered buckets. So you got a bucket here, you got a bucket here, you got a bucket here, you got a bucket here. Now, as we go down the time segments here, well, we can make this more aggressive. So we have less cash in this portfolio, more stocks, U.S. stocks also. We have bonds. So maybe this segment or this bucket is earning 4%. And maybe I'm just going to use really simple numbers, +4 -4, right? It can earn 4, drop 4. Now, I have to tell you that historically, our segments have earned more, but we're looking forward, not counting on what we return over the past a decade or more, which has been really great growth. As we move down, now that'll fund years 4 through 6. And as years 4 through 6 become today, well, of course, we move these funds now. The 180,000 is spent. Now this 180, we have to now spend, and we'll reallocate it into this type of segment, right? So it becomes more conservative as it conveyor belts down. Years 7 through 9, well, we could be more aggressive. This can be +6, -6, for example, right? So you'll see we've got more stocks here. We've got 55% stocks, 15 or US stocks, 15% non-US stocks. So that's more like a 70-30 portfolio. So +6, we'll see more volatility there. But we're not going to need that money for the next 7 to 9 years. So that's okay. We're going to, if the markets drop significantly, we're not really going to worry about that money. If most of your money here, if you think we got $169,000 we put in here, now why is this $160,009 less? Well, there could be changes needed in their retirement spending, but also there's inflation here. So maybe they're going to need to spend $195,000 during this segment, but we're growing the money, right? So it's less money we have to put in today to fund down the road. And again, if there's volatility, well, we don't know, we don't need, this money for the next 7 to 9 years. So is that really going to keep you up at night? It shouldn't. And that's why we have these separate accounts. We've had discussions about, well, can't we put it all into one account? Because, we're opening up sometimes 4, 5, 6, 7 accounts, more sometimes for people. But my argument would be, well, that's a hassle for us. And sometimes a lot for a client. The psychology says, well, I know if this $180,000 is here, even if this markets drop and I'm down, 10% in this portfolio, I know I don't need that for the next 7 years. And we remind you of that. So it makes you feel better. And you know where the money is coming from, because don't think for a moment that investing isn't about feelings. It's about worry. It's also about another feeling. It's also about FOMO. Anybody ever hear of FOMO? Raise your hand for me if you've ever heard of FOMO. Well, kids, that is the fear of missing out. And the fear of missing out is a real feeling too, because not only do we have this worry, but if you just put all your money in cash, even if you can get away with having all your money in cash, you got several $1 million and you live well within what you have, and you can put it all in cash, there's still going to be moments in this 35 plus years of your retirement where you're going to say, if I only would have. I have a great Amazon story I'll share with you. So when I was a financial advisor at Wells Fargo, Wachovia, I bought a Kindle, the second generation of Kindle. And I said, boy, this thing's really neat. And I remember there were several $100s at the time. And I said, if I could get one for $50, I would do it. Well, it turned out one of those, just funny things that happens, I got some kind of credit from my American Express card, or, I don't know if it was miles, but anyway, the thing cost me $50 with a leather cover. So it was right there. It was white. It was big. And I was reading books on it and having fun, and everybody wanted to see it. It was this big deal. And there were message boards about people driving places to see other people's Kindles. So I thought and this was before Amazon is what Amazon is today, right? Before it was the big superstore for everything. They were all about books. And I said to myself, this is going to be huge. All the universities, all the schools, this is the wave of the future. And I bought a bunch of Amazon stock, a bunch for me at the time. Amazon was trading at about $35 to $40 a share. And that play didn't work out for Amazon, right? So I did well with Amazon over the years, and something, as a younger person, I needed the funds for something, and I sold out of my positions in Amazon. Well, needless to say, Amazon's selling at $3,000 some a trade. That would have been, or of the share, that would have been a really, really nice holding in my portfolio right now. Now I still own Amazon and various exchange traded funds and mutual funds I have, but I like everyone else have this, this feeling or fear of missing out. So we don't want to have all of our money in cash. We don't want to have all of our money in bonds, certainly. But isn't it smarter, if you can do it, to spread it out for times in your life when you're going to need it? Because again, if this portfolio all the way on the end here is plus 10%, minus 20%, let's just say, and the markets are down and this portion is down, and you know that you don't need this for the next 10 years, you're probably not going to worry about it. And if you are worried about it, this is a really good time for that remind and review conversation. But when it's up, you're going to be really happy about it. And you're also going to eliminate that feeling or fear of missing out. So the thing I like about this segmentation approach is that it helps eliminate this worry, helps eliminate this fear of missing out, gives you exposure all along the spectrum, and does exactly what we want things to do. And that is to take you from retirement to you're no longer here, right? And fund every segment of your life with you knowing exactly where those funds are coming from, how they're specifically invested for that portion, and how your retirement is going to be funded. So in my opinion, those three pillars, right? We have asset allocation, we have principal protection, and then we have account segmentation. You know, that's just a really good way of having that. Oh, look at that. So you got kind of that stool, you know, three-legged stool thing. So I like that approach. It works beautifully, I think, now. Does it mean I won't change things in the future? Of course not. I'll tell you that this is plowing fields with an ox, this account segmentation. You know, it's asset allocation, anybody can do. You can do it. You can do it on many, many different websites yourself, if you're so inclined. Principal protection is harder because of access. Very, very few. I don't know. I don't know of any Vanguards. You know, I'm a fan of Vanguard. Vanguard Fidelity, you can do annuities, but I don't think they have principal protected annuities. Maybe they do. But this is the difficult thing. This is access. You know, we have the universe of principal protected. I was on the phone with our fixed income trading desk yesterday, and we were going over principal protected and buffered notes and CDs. That's an option too. Account segmentation is plowing the field with the ox. That is a tremendous amount of work, and I don't know how an individual would do it without the tools that we have. So, but it makes, you can see, I think, how it can make all the difference in the world. So, okay, that is my presentation or my discussion today. And you'll see why I didn't want to spend much time on the markets today, because this is a lot of material, and this thing's kind of going crazy right now. So we do have a question here. Gerard is asking, do you also factor in future tax consequences for taking RMDs that create cash needs? So RMDs that create cash needs. I'm not sure what you mean by that, but let me try to answer the question. RMDs are required minimum distributions that are, so they're required distributions that must come out of your IRAs. We've talked about this many times before, based on a factor that the IRS gives us after currently you turn age 72. There's discussion in Washington about making that age 75. So that creates cash that you may or may not want. You might want that cash. So let's say you have $30,000 that comes out via a required minimum distribution. The IRS says you must take it. If you don't take it, you owe them a 50% penalty, 50% penalty. That's a lot. So you got to take it out. And if you need to spend the $30,000, fine, you spend the $30,000. If you only need to spend $15,000 that year, well, too bad, you got to take out 30. The big issue, as you all know, coming from me, is what's the tax rate going to be on that money? Well, we don't know, but my studies show that in the next 10 years or so, it's going to be, for the average middle-class American, somewhere between 40 to 45% effective tax rate. And I just don't know how anybody can argue that at this point. But do you also, let me go back to Gerard's question, because I'm having a hard time to understand exactly what's going to, do you also factor in future tax consequences for taking RMDs that create cash needs? So maybe what he's saying is the RMDs are going to be taxed. So if you have to take a $30,000 RMD, you're going to have to pay tax on that money. So the answer is yes. So we get to these numbers. I think I'm still sharing here. We get to these numbers here, the 180,000, the 169,000, the 969,000. And this 969,000 in Frank and Joanna's case is money that I believe they're going to need. But many times that's a legacy longevity section that you're probably not going to need for the rest of your life. So that gives you the ability to identify what's kind of in reserve that you're not going to need. And that is really helpful too. So these numbers come about through financial planning. So this is the investment side of financial planning. The income needs, the cash flow needs are derived from, do you have pensions? What's your Social Security? Do you have any other income? Are you going to be working part-time or not in retirement? Do you have rental properties? So it all comes from those numbers are not just made up, and they're not just Frank and Joanna told me they need $10,000 a month. We get into the details. Anybody who's ever been through the financial planning process with us knows that we get into the details. And that's why people like to deal with us, right? And they stay with us because we truly do financial planning. So I'm going to pat myself on the back a little bit here, but the company we use for financial planning is called eMoney. So eMoney is out of Conshohocken, Pennsylvania, another smaller organization that got very big and was bought by Fidelity. eMoney is probably the most widely used financial planning program in the United States. We are told all the time when we call in with questions to the help desk that we have the most in-depth plans that people have seen. And I'm proud of that because we take it very seriously. We truly do financial planning. And I'll tell you, I'm not knocking the other folks, but they just don't do what needs to be done. The majority of them. There are some who do, but many don't do what needs to be done to really identify the potential risks, issues, and be able to correct those things. But people get very lucky, and that's okay. So, Gerard, I hope I answered your question.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.